Good morning, and thanks for joining us here on Treasure Coast Solutions. Wednesday mornings, when I feel like it, we have a show from 9 to 10 o'clock talking about whatever I want to talk about because I pay for it. No, it's generally for those of you who are new to the show. I'm sorry, you're one of the few that are left. The people that have heard it for a while are no longer here. No, we do talk about some economic issues. It's kind of political a little bit, but I always used to say it wasn't. But it's hard not to talk about economics without getting into some of the political issues that surround some of the choices that we make economically and financially. So I'm not going to say that anymore. I'm turning over a new leaf in the new year, and I'll just come right out and say it. It's there's no way around it. It's economics. You like it or you don't like it. You can have your own opinion, but it's a science, not an art. So anyway, it is what it is. So we one of the things I did want to talk about, though, coming up this year, and is where we're going from a planning standpoint. And a lot of times, some of the things we talk about, we're talking about things maybe at the international level, and some at the national level, and some at state and local, and that type of thing. But there's a few things going on that I think people need to be aware of going forward. And so there's just some things I wanted to kind of throw out there. It is a call-in show, so if you've got a comment, 220-9788, 220-WSTU. We welcome your call. You can feel free to give us a buzz and throw in your comments. I am not an economics professor, so I'm actually a CPA by background and a banker for a number of years. So a lot of my economics training came in the banking area, where you get to deal with some of that stuff on the front line. I got to give a lot of our bank management people credit for dealing with some of this stuff and how you have to plan for some of the things that are going on in the economy. I know as a CFO of a large bank, one of my primary duties throughout the year was to come up with the budget. And for a bank, the budget is all about forecasting interest rates and forecasting the timing and movement of those rates and the economy to determine losses or potential losses from loans or new product and new business that you could put on, things like that. So it was kind of a really interesting thing where, a lot of people look and say, oh, I'm going to buy these supplies, or I'm buying this supplies and that when they get into their budgeting process. But with a bank, the big numbers are interest rates going up? Are they going down? When are they going up? When are they going down? And how much? And so it was an interesting proposition. And I give a lot of credit to those people that have to try to do that and deal with it. We used to, I know when I was in Illinois at a smaller bank, we didn't have our own economists. So we would utilize all the big banks. And at that time, that was First Chicago, Continental, Harris Trust, Northern Trust, American National Bank. They were the big ones. And they all put out forecasts every year of interest rates and what was happening with interest rates and what they saw on the horizon. I'd love to see that. I'd love to see that now. But it's funny because nowadays I doubt very seriously that those banks publish any of that in any detail, because it almost becomes, if it did, you could kind of determine where they're going and what kind of from a competitive standpoint, what they were going to be doing, and it might put them at a competitive disadvantage if you know what types of things they're doing. But it was an interesting process, and I tell you, one of the things that I thought was kind of interesting back in the day is it's important to understand why people are doing things, because we talk about economics. I talk about economics on the show, and I talk about some of the things that take place there, and cause and results. That's that's the reason that or some of the reasons we talk about is to understand, okay, if this is actually going to happen, then what's going to be the result of that, and what do you want to do, and but there's another factor in there, and that is in general, it's how it impacts you in particular, whether you're a business or an individual, what the individual aspect of that is. And so I'll give you a good example. Back in the day, when I was up in Peoria, Illinois. We had it was my first banking job in a bank, working in the bank itself as a CFO. Previous to that, I'd been in public accounting. I was with Arthur Andersen in their banking division in Chicago, and I was with McGladrey in Peoria in their banking division. And so most of the time I was dealing with banks from an audit standpoint. This was my first experience with banks from an operational standpoint, where I was actually employed by the bank. And so one of the first things I was tasked with was kind of doing the budget. And in the past, the person that had my position was the CFO. He was a CPA, and he worked for Pete Marwick before that. He had gone to he'd become a loan officer, and in our bank. And so anyway, so he was there, and we used to always project. We used to always project the budget based on what was referred to as the net interest margin or net spread. That's the difference between the yield on your assets, your loans, and that type of thing, and your cost of funds, your interest rates on your CDs or any of your deposit accounts, that kind of thing. So that was in the day when they used to do that. They used to just budget that at a fixed amount. They used to say, no matter where interest rates going to go, we're going to have a 3% spread or 3.5% spread. And so, but without breaking that down into detail, without looking at the individual components, you really, there was no way that number was accurate. Because, for example, if you have a large amount of auto loans, installment auto loans that are in those days 3-year loans or 4-year loans that are fixed in interest rate, then you can't change the rate there. So if interest rates go up and your deposit rates on your CDs are rolling over every 3 months or even every year, you're going to change costs on your CDs 4 times before you can change the interest rate on that loan once, right? So when interest rates go up, you're not necessarily going to keep a 3% spread because if your cost of your money, your cost of your funds are going up, but your rate's not changing, then that margin is getting smaller. And so you have to diagnose or look at these things in fairly small detail to determine at least what these classes of assets are going to be doing. And so it was kind of funny because when I did that analysis for this bank, it determined that we were going to, that if interest rates went up 2%, we would be broke. We would use up all of our capital. We would lose enough money because we had a large amount of fixed rate securities, investments, treasury bills, and U.S. Treasury bonds and things like that. And we also had some loans that were fixed rate. We had some municipal securities that were fixed rate. So we had a lot of fixed rate stuff so that if interest rates went up, our yield on our assets didn't go up because they were fixed for some extended period of time, whether it was securities or auto loans or, whatever it was. We had very few floating rate loans, business loans that were tied to prime or anything like that. And our cost of funds had been deregulated because this was in 1978. And many of you remember back in that was the Carter era. Remember when mortgage interest rates were where your mortgage was 16% fixed and you thought you got a good deal? Remember that? That's what we were talking about. That was right before that. And I don't know if you remember, but what happened actually is that interest rates spiked and then came right down. So they had gone way up, went right down. And then after that, a little while, went back up again and really kind of didn't come back down for a while. And so I had put together a projection, and based on the interest rate scenarios that I'd gotten from Harris and from First Chicago and those kind of things, it was it looked like interest rates were going to go up at least a couple percent. And this was before they spiked, so there was an indication that we're going to go up at least a couple percent. Well, that meant that we were actually we were actually going to be losing money. We would have had a negative net interest margin, which meant that all of our overhead wouldn't be covered, salaries, everything else. And basically, from an accounting standpoint, when you're not at least covering your variable costs and providing something to fixed costs, which is what we weren't doing, you should shut down. I mean, you're out of business. Well, what happens is if you were any other business, you wouldn't be able to get any capital. You wouldn't be able to survive. Banks can survive because they never run out of cash. A little secret about you know, losing money in bankruptcy. It doesn't make any difference how much money you lose, as long as you can replace it. So for most of us, we can't replace it. If we lose all of our capital, we're out of business. If we can't go to the bank and borrow money, we're out of business. And who's going to loan you money if you're losing it all, right? Well, the exception to that is a bank. Banks have this unique position that they can lose money forever, and consumers will continue to put money in their bank. How many of you out there actually ask the teller when you're making a deposit at your bank, or many of you probably just scan your deposit in? How many of you actually pull up the bank's financial statements at that point in time to see if the bank is making or losing money? And if they are, how much? Probably nobody. Well, for one thing, you've got insurance, right? So you say, well, I got 250,000, and that's it. And so what's happened is the U.S. government has protected banks from being stupid by providing deposit insurance. Because what should happen is you should look at that bank and say, well, look, I'm going to have a banking relationship with you. I'm going to have my money here. I want to see how you're doing. And if you're not doing well, you're doing stupid stuff, then I'm not going to leave my money with you. But what happens is the government comes in and guarantees that. And so they protect banks from their own stupidity. So banks can take bigger risks. They can do things that are more, that are not really prudent, because if they make a mistake, they've got the government to fall back on. And so they'll still get money. So if they lose, the depositor will still bring in their paycheck and put it in their bank on Friday. And that's what happens. And so they can continue to make these mistakes. Now, when you take it one step further, like we did back in 2007 and 2008, and the government basically comes out and says, you are too big to fail. So not only are we insuring your deposits, but we're going to insure everything you do. You're just too big to fail. Well, then you've got a disaster on your hands, because that bank is going to make a lot of stupid decisions. And they are going to be a very powerful competitor to the small banks, like the community banks, that don't have that kind of protection. And so here's where you've got a situation where you've got the community banks that have to deal, first of all, in their community. They don't have the the ability to go to New York State or to Massachusetts or whatever, or to London or to wherever. They're kind of stuck right here in Stewart or in Martin County or whatever the area is. And so they don't have as much diversity in their customer base, and a lack of diversity is risky. So what you've done is you've allowed the big banks who have diversity in their base, but are maybe stupid, you've allowed them to push the community banks into a situation where they have almost no diversity, and yet they have to offer products that you would not normally offer at rates, and because their competitors are offering them. Like right now, for example, a lot of businesses, well, it's not true right now because of all the COVID stuff and all of the money that's been pumped into the system, but banks are kind of reluctant to lend anyway now. But previously, it was a case that if you went to a big bank, and I won't mention any by name, but if you went to a big bank, they'd give you $100,000 line of credit as a business without much. If you'd been around for a while, there wasn't really much underwriting. Why? Because $100,000 for a major bank, and I'm talking, the really, really big ones that out there, like the Citicorps and Chases and and Wells Fargo's, and I'm not saying each one of those did that, but I'm just saying those big banks like that, they have $100,000 loss to them is nothing. If you don't pay that loan back, now they don't want to lose it, but if you don't pay it back, it's nothing. And in fact, they're making their money off of the big customers, the Wall Street concerns, and they're actually loaning, hundreds of millions of dollars to some of these companies, and these companies have never produced a profit. Now, why would they do that? Why would they do that kind of thing? Because because they've got the backing of the U.S. government. They've pretty much been told, we're going to stand behind you, and the government's standing behind them in one of two ways. They're standing behind them by either saying you're too big to fail, which they have, or they stand behind them by telling them that the company that they're funding, that they shouldn't be funding, is too big to fail. In other words, we need it too bad. It's created too many jobs. Well, frankly, Wall Street doesn't create much in the way of jobs. Main Street creates all the jobs. So that's really an incorrect assumption. And all you're doing is picking a winner, and then making other small businesses in general be losers, because they have a hard enough time competing against some of these big box locations. And then, to be offset or have somebody basically say, look, as a bank, we're not going to shut you down if you loan to this big company. And as a big company, we're not going to shut you down if you continue to lose money like you have been, because you're too big. You employ too many people. I mean, that's what the Obama administration did with General Motors. And that's what, by the way, I think we're going to see going forward. And we really need to pay close attention to this, is that our current executive branch and our Congress, frankly, has no problem picking winners and losers. Now, government knows nothing about business, so they will pick all losers. That's just the way it's going to work. So the government is going to pick losers by picking people who they think should be the winners. And so when they go in and they save a General Motors, like happened in 2007, 2008, they saved a few jobs, but they cost Ford a bunch of jobs. Why? Because they picked General Motors over Ford. Ford was playing by the rules. They were dealing with, they had paid off debt. They were doing some things to try to weather this recession that we were facing, or depression, and they had made the right moves. General Motors had not. They had gone into a product that nobody wanted, the Volt. Nobody wanted to buy it. It was not working, and it cost them a lot, and it should have cost them the company, really. It was a decision that was so stupid at the time, so that their product decisions at the time were so stupid that whole entity should have been merged and gone away, and probably would have been had the government not stepped in and said, you're too big to fail. So that's what we're going to be facing. So when I talked at the beginning of the show about you need to pay close attention from a financial planning standpoint, because individual stocks are going to be much more risky than they were in the past. Most of the time you can talk to financial planners, they'll tell you need to diversify. We need some financial diversity, because and so your holdings need to be large. That's why mutual funds were out there. That's why ETFs were out there, and those kind of things, EFTs, those kind of things were out there that allow you to break out the market and diversify by owning a bunch of companies instead of just one company. So if I think that the automotive industry is going to do well, I can buy a package that's the automotive industry and includes all of the automotive companies and related parts dealers and all that kind of stuff. Or I could buy General Motors stock. Well, if I buy the stock and I pick General Motors, well, the auto industry could still do well, but General Motors might not, or Ford might not. So the more you make that smaller, the bigger risk you've got. From an automotive standpoint, the more you, even that is creating risk, as opposed to, what if some other form of transportation does better? What if, Uber or somebody else that's, outside the auto industry, what if that, kind of shuts things down a little bit? So anyway, there is all of this. There's all of these things that have to be looked at when you get into the details. And getting back to my budget story, that's what I was saying, is that nobody was looking at the details. And if they looked at the details, the picture was very obvious. We were in trouble. And as a bank, we had serious issues. Uh, and it was hard for the executive management to come to grips with what I was telling them for a number of reasons. One, I was fairly young. So I was like 24, and I happened to be the same age as the CEO's son, who was sipping Coronas on a roof in Texas. So it's hard to take advice from somebody when every time you're talking to the guy, you're thinking about your son sipping Coronas on a roof in Texas. So that was one problem. That was something that politically I could get around. But it's a politics of the decision. So when I said earlier that it's hard to talk about economics without talking about politics, there's politics that come into play at the individual level, at the national level, that come into play on the decision making. And so those politics, you're still going to get the same answer, but those politics can screw up the reaction to it, so that some people, may come out better or worse, but it's still going to be the same general thing that's going to happen. And so when you look at some of these things, it's important, like I said, to understand the details. So um, uh, we had this situation. Like I said, the first problem I had is that I was young, and it was hard for them to believe me. Uh, Coupled with the fact that the guy who had been in the position doing the budgets, who had shown all these good numbers, was now the loan officer, and he was arguing, no, that your margin's too small. So I had to first of all go prove to them that my math was right, and that took a couple months. In the interim, the solution to the problem was to actually sell a bunch of things, a bunch of securities that had been purchased by the old CFO, the now loan officer, and the CEO, that were going to cause a big loss and wipe out our capital. Now, had we done that, we would have restored that capital within about a 1 year period of time, maybe 18 months. Okay. But in the interim, we would have wiped out our capital when we had just sold stock at $10 a share. So it was a very difficult situation politically. We knew economically what was going to happen, but politically it was very hard for the bank to make this decision, because they wanted to believe that it wasn't true. So they found out reasons. So they throw up reasons why it's not true. And this is what happens in economics. They throw up the steps in between and say, well, see, because this happened, it's not going to happen. You're wrong. This is as a result of this, not that. So I'll give you an example. So I showed this, and the CEO said, well, the reason our profits went down this last 6 months was not because of that spike of interest rates, and not because you had this mismatch of your assets and liabilities, which is what I was arguing. It was a seasonal thing, because we were in an ag community, and it was a seasonal situation, and that because we had a seasonal loss of deposits and increase in loans, that's what had caused our problem. Well, it was not. It exacerbated our problem, but it didn't, because we didn't have as many non-interest bearing deposits. A lot of our checking account balances were down because the farmers had drawn those down for planting season and things like that. So, but I went to the Federal Reserve, and under a special program they had, I got plenty of money that we were out in deposits at almost no interest cost. It was a fixed rate, small cost, less than Fed funds, and so and that's the rate that banks charge each other. So it was less than that. It was money directly from the Fed, which, by the way, is what's happening today. The Fed is pumping money directly into the economy through the Fed discount window, which they never do because of the impact that it has on interest rates and everything else. But that's what's happening right now. So that money that's being pumped into the system is flowing through the Federal Reserve's back door, which almost never happens. And so when things start getting tight like that, the next thing that'll happen is you'll see the Federal Reserve will adjust the amount of money that banks have to have on deposit with the Fed. That all banks have to maintain a certain percentage of their deposit base. You would hope it would be 80%, right? Or 70%, that there's actually real money out there backing them up. But no, it's around 2% or 3-5%. It's less than 5%. I think it's down around 2 or 1%. So it's a very, very small amount. And they almost never adjust that. But if you get a situation where money gets tight and banks aren't loaning, they will adjust that. Just like they can pump money through the discount window, they will adjust that depository amount so that banks have to keep less in reserve in their reserve accounts, and that gives them more money to lend. So what happened is the first thing that the bank CEO and the chief lending officer threw up was, well, this was seasonal. So we went out and took care of the seasonal stuff, but I showed him that it was not seasonal, that it was, we had a large fixed rate loan that was a couple $1 million that was fixed at 8%. And we had a significant amount, about $10 million worth of municipal bonds that were fixed at a face rate of about 4% at the time. But they were yielding, because of, supposedly, if you have a tax break, they were yielding about 7 or 8%. Well, there's the key. If you're losing money, you don't need the tax break, so you're only yielding 4%. So what happened in this analysis is that for this bank is that when interest rates went down, when interest rates went up and the bank started losing money, the yield on their after-tax yield on their municipal securities went down to the coupon rate, 4%. It went from like 8 to 4, or 6 to 4 is where it was at. Actually closer to 6 to 4. So now you're losing 2% basically on that, even if you were break even before, and they weren't. So that was what was happening, and it was very hard for the CEO to deal with that. And finally, they paid a lot of money to a consultant out of Kansas City, who came in, and I went out there, and we spent, and it was for a small bank, we spent about $12,000 paying these guys. They were $1,000 a day, and Jerry Swords is the guy's name. He was an amazing guy, one of the forerunners of a lot of the stuff going on in the banking industry back in the day. And so went out there and worked with him. I showed him all my numbers. He flew back in for the meeting with the CEO and the chief lending officer. And it was kind of funny because I was sitting there, and I didn't know what he was going to say. I didn't know what Jerry was going to say. And but I knew he had gone through it, and I knew he had looked at our loan portfolio as well. And and I told him, look, I don't think we have credit quality issues on the loan side. Our issue was primarily, this net interest margin problem, and this gap, they call it gap problem. And but anyway, so he's sitting there with the CEO and with the chief lending officer, and and the CEO, guy named Chuck Yagner, he looked at him and he said, okay, so Jerry, what should we do? Now, keep in mind, they just spent, $12,000, which was like, I think a quarter of my salary. So, no, actually it was half of my salary at the time. I think I was making about 25 or 30, somewhere in that range. But anyway, and Jerry looked at him and says, well, he said, the first thing you should have done is not pay me $12,000 and just done what Mark said, because that was the answer. And so then the CEO goes, well, what do we do now? And he says, well, now you don't have a choice, because you've gone so far down the hole that your only choice is to sell. So he said, I'll help you put a package together and we'll sell. In that time, in those days in Illinois, you could only sell if you were a distressed bank. So what he was basically saying is that you're a distressed bank, you'll qualify. Which was, and again, those interest rates had spiked. The CEO had not done anything. The next round, they stayed up for, we were in it, and we were already losing a significant amount of money. And it wasn't that the interest rates were going up 2%. The interest rates had gone up by 5% or 6%. So now we were basically going to run out of capital and be insolvent within about a 4 to 5 month period of time. And he had wasted about 2 months of that while he was trying to make a decision. So bottom line is the bank ended up collapsing. But and my point of the story is it's important to understand the components, because if you're looking at the big picture, it's good to know the big picture, because in economics, it's good to know where you're going. The macro is important, but the micro can be very, very significant too. And knowing where the components and what's going to happen to some of those components in the interim is important. And I like stories, so I'll tell you two of them that I think are interesting. For one of the comments in this bank situation that came back to me is um, the the CEO said to me, "Mark, you've got to be wrong because Commercial National Bank, which was the big bank in Peoria at the time, they were huge." He says, "You've got to be wrong because Commercial National Bank is out there making fixed rate loans. They've lowered their interest rate on car loans, and they're making car loans like crazy." And he said, "So if you're right, why are they doing that?" And and he was friends with the CEO over there. My CEO had come from the regulated industries division. He was part of Silco in the lobbying area for a utility company. So before he was a banker, so he really didn't have a solid financial background. But he was friends with the CEO over there, and the CEO had told him, "Yeah, this is what we're doing. We're offering all these loans." And he said, we're going to put on a bunch of loans." And so I said to my CEO, I said, "You know what? I don't know. Maybe their situation's different. I haven't seen their books. I haven't seen their details. But I said, in this market with interest rates going up, there is no reason to be doing what they're doing. None that I can see. Um, and so there's got to be some reason behind this that is not obvious. But I said, I'm telling you, we're doing the right thing. I don't know why they're doing what they're doing, but it doesn't make sense on face." It was interesting. About 30 days after that, uh, through a number of other sources, actually found out what they were doing. And if you keep in mind that banks can make money, banks make money by taking interest rate risk, by making fixed rate loans, those kind of things, by taking that kind of risk. But their big thing is by taking credit risk. They loan money to businesses based on that business's credit, and then they either live or die based on how that business does. And if that business goes out of business, they could lose a lot of money because they're going to lose their loan. So their losses can come in interest rate risk losses or in credit losses. And historically, that was credit losses were the bigger issue. So it turned out that Commercial National Bank, they were doing what's called floor planning loans to some of the major car dealers in Peoria. I mean, these were the biggest car dealers in Peoria, huge Chevy dealer, and I think a huge Ford dealer. And they were doing these things, and they were providing these floor plan loans. So they were making like $15 and $20 million loans to $15 or $20 million loans to these companies, these car dealers. And the car dealers, because interest rates were going up, people weren't buying cars, they were starting to suck wind, and they were going to lose $15 or $20 million. So what did they do? They went out and offered low interest rate car loans to encourage people to buy cars from these dealers so they could reduce their floor plan exposure and thus not lose $15 million. What they were hoping to do was convert $15 million worth of floor plan loans into $15 million worth of small consumer loans where the risk of loss was almost nil. And they were willing to risk taking some interest rate loss over a period of time in exchange for avoiding that credit loss. And the funny thing was, because the small banks just automatically were trying to do what the big banks did, they had the whole community taken care of them. All these other small banks are out there making these discounted loans because they're trying to keep up with them on the retail side, and all they're doing is helping them get out of their problem on the commercial loan side. So it was funny. All of these little banks ended up bailing out Commercial National, and they didn't even know it. They had done it in a sideway. So it was kind of an interesting situation. So it turned out so it's important to know. That's my point. It's important to know what's potentially going to happen and how the parts are going to be affected and what's going to happen in terms of that. Right now, we're talking about a budget. We're talking about spending trillions of dollars. We're talking about a $23 trillion deficit, which is as big as gross national product. So we're talking about a significant amount of debt. And with that kind of debt, you cannot survive. I know, you may not be an economist. I may not be an economist, but I'm smart enough to understand that if I continue to borrow money, at some point, I have to pay it back. Now, if I'm a Keynesian, I think that maybe I don't, but I've been proven wrong over the last 200 years pretty consistently. So I guess maybe I shouldn't be a Keynesian. But if I'm a Keynesian, I continue to go down the rabbit hole because I continue to get distracted. Keynesians are like cats. That's how I remember them. Keynesians are like cats. If you throw shiny objects at them, they get distracted. And that's what's happening with many Keynesians from an economic theory standpoint. They constantly have shiny baubles thrown at them, and it distracts them so that they think that they're right again. And if we just do it this way, if we just do it this way, or they point back to a situation where, they say, well, Larry Summers made it happen. He didn't. We didn't have. He stopped the recession. Yeah. He stopped the depression is what he stopped. But what happened afterwards? We had the slowest job growth in history. We had an economy that was horrible, and it would have collapsed again. It just, in the interim, it got a shot to divert it, but it didn't solve the problem. The problem is still where we're at right now. We are in trouble financially. You can blame it on COVID. History will say, well, it was COVID. But the fact of the matter is our economy was extremely weak going into the Trump administration. And what Trump did bolstered some things, but it also was a long-term solution that in the short term was not going to have real favorable short-term results. You say, well, how can that be? The stock market did well. Don't look at the stock market. What you got to look at is the rest of the economy, and what was happening is that Main Street was still struggling because of the strength of China and because of the products that were being manufactured in China and that kind of thing. And we still had trade problems and trade imbalances because the solution to the trade problem was a long-term solution, and they were trying to work that out, but it wasn't going to happen immediately. So, like I say, you've got to look at what's going on now. You've got to look at some of the parts, and it's important to understand where those parts are going to end up, not necessarily where they're going to gravitate on the interim. But if I was looking at some issues from a financial planning standpoint, there's some things that I would be concerned about. One, I would want to make sure that I'm diversified in any kind of portfolio that I've got. And I think that probably large cap stocks are going to be winners rather than small cap stocks. So, I think NASDAQ and some of those are probably going to take a beating. The S&P 500 is to some degree going to take a little bit of a less of a beating, but a beating. I think the Dow is going to come out the best because it consists of monopolies, and most of a lot of the large companies in the Dow have a guaranteed income because the government is taking care of them. Now, would I pick a specific stock within the Dow 30? No, because I don't know what government, I don't know what company is currently going to have favor with the current administration. Because right now we're talking about pork, and we're all back to the scenario where whoever's got the biggest grease is going to get taken care of. And so I would be concerned about picking a winner by picking an individual stock in the Dow, but I would be concerned, and I would maintain some diversity, but I would probably lean towards large caps from that standpoint. But they're going to get hurt no matter what. What we're talking about is ones that won't go out of existence. If I own Walmart stock and Walmart goes broke, my stock, it doesn't make any difference if the rest of my portfolio is okay. If all of my stock was in Walmart, I'm done. Maybe I should have been Target. Target might still be around. But so what I'm saying is, when you pick an individual winner, the deplorables that shop at Walmart may be the ones that don't get the benefit of certain things. So I'd stay away from picking individual winners, whether that's in the stock market or anywhere else. The other thing that I think you've got to look at is we're going to see inflation. I think we're going to see Jimmy Carter inflation. How long it lasts, I don't know. I mean, my estimate back in the day was that the interest rate cycle in that day, and what I mean by that is when interest rates start rising, the time it takes for them to come back to where they started at is the interest rate cycle. And that used to be roughly 36 months was the interest rate cycle. So what that meant is that if you could ride it out for 36 months, you probably would have an opportunity to correct your problem within that 36-month period. Over the years, that has dropped down to about 18 months, and we've got probably about an 18-month cycle that the economy can't handle because of where we're at, the amount of debt in the economy and all that. The economy can't handle more than 18 months, if that much, of a high interest rate. I would say realistically, if interest rates go up to 6%, 6 or 7%, 8% on the government side, I'm talking about government bonds. You're talking about a lot of businesses having problems, a lot of people having problems, and I think it's going to cause first of all, the government deficit will get substantially larger because of the fact that government bond rates are high, but the cost of debt in the budget right now is minuscule. I think it's down in the low 1, 2, 3, 4%, maybe 5. I don't think it's that high. But historically, interest on the national debt has represented about 70 or 80% of the overall budget. So if we've got this huge overall budget, right now, interest is a very small portion. If interest rates go up to 5 or 6%, interest will be a very large portion of the budget. So not only will we have to cover all of these other things we've agreed to, the free college, the free healthcare, the free this, the free that, the money being sent out, the stimulus, all of those things, the minimum wage, the higher unemployment, all of that stuff, we'll still have those costs. We'll still have those trillions of dollars of costs. But now that trillion will represent about 20%. So let's say we got 2 trillion, 2 trillion, then we're talking about $10 trillion our budget deficit would be. 10 trillion in just 1 year. So that's what we're potentially looking at. I guarantee you'll be looking at significant inflation so that $1 trillion worth of debt can be paid back, or you'll be looking at an overall collapse of the economy that'll be devastating because we won't be able to pay our debt back. At least in the past depressions that we've had, we've been able to pay, the government has been able to pay its debt back. It may have caused a lot of problem, but we would be bankrupt. I don't know that we could pay our debt on debt. We have defaulted or potentially because politicians couldn't agree on a budget. But we were in a position we could pay the debt. We were just having a big argument about it that was a technicality, really. Just all it was a technicality. And the world knew it was a technicality. But think about if the world didn't know that. Think about if the world was concerned that all of the treasury bills and all of the treasury notes and all of the government money that's out there, all the Fannie Mae loans and Freddie Mae and all the mortgages, that those will not be paid back. That the government does not have the ability to honor its guarantee and cannot pay it. What are they going to do at that point? I tell you, it will cause panic because the world in general has got problems. We look at our situation and what's going on. We haven't even talked about what's going on in the worldwide economy, and economies are being devastated by this. We had a huge effect by COVID, but Great Britain has had a tremendous impact. France has had a tremendous impact. Germany's had a tremendous impact. All of these countries that were generating most of the world wealth and the world income are, in the toilet. So what's going to happen? How are they going to be subsidized? They're not. You don't subsidize a world economy. The U.S. has been the one that's kind of subsidized the U.S. economy. China has been the one that's been subsidizing the U.S. economy. China's got problems. They just don't show it. They can hide it because they're a communist country. They don't have to show you what the problems are. They do that internally by what they pay people, how they pay people, what jobs people get, and what favor people get. They end up doing things like that. So So what I'm saying is pay attention to the details. Take a look at what's going to happen. Look at and make sure you're accounting for inflation and potentially severe inflation. Make sure you're looking at the wiggles and waggles and dips and that can take place in between. And I told you I got another favorite story. So here's my favorite story. So one time there was an economist, and he and his wife and kids went up to the lake, taking their summer vacation, which they always did. And so they're up at the lake, and the wife and the kids were inside, getting things unpacked, and the economist, husband in this case, not the wife, was decided to take a walk. And so he said, I'm going to take a walk. And so next thing you know, there's all these ambulances and everything going on, and they're pulling this guy out of the lake, and he's drowned. They pulled him on shore. They're trying to, but he's drowned. And so the police are investigating, and they ask his wife, he said, was he despondent? Was he, what was the problem? Was he depressed? Was he despondent? Because, some people that saw it said he just walked into the water. He just walked out into the water and drowned. There was just no reason for it. So, was he depressed? Was he committing suicide? Did he leave a note? And she said, no. She said, all he said to me was, on average, over time, that lake's only 4 feet deep. So that gets to show you that it's those little valleys out there, the 6 or 7 foot valleys, that can make a huge difference in the outcome. So as an economist, I tend to deal with averages, but as an individual, you have to deal with the details. You have to deal with the wigs and waggles, and some of the, like I said, the baubles that the Keynesians get affected by, because their path to the ultimate outcome is a correction of the economy. That's either a correction through depression or a correction through hyperinflation and a devaluation of the currency. One of those two things are going to happen. That's got to happen, because there's no other way around it. But how we get there and what happens in between to the individual companies at the micro level, that's still going to be hard to tell, because we don't know who's going to favor what. So anyway, that's just some of the things I think you need to take a look at. Maybe meet with your financial planner early this year and try to see where you're at, so you can see what it looks like going forward. Join us every Wednesday here on WSTU. We'll talk about things that you want to talk about right here on WSTU Digital 1450. We're Martin County's Heritage Station.